If you don't impose a no-fly zone, there can be only one conclusion. You also want us to be slowly killed. If they continue to do what they are doing, they will be putting the issue of Ukrainian statehood in question. The external environment is becoming increasingly complex, grave, and uncertain.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, here's what's coming up on today's program. The U.S. could go solo in banning Russian oil imports. The Bloomberg report on a potential Russian embargo sends a shock through the markets. The stakes rise. Putin repeats the war in Ukraine will not end until his demands are met. A third round of talks may happen today. And stay with Bloomberg Surveillance Early Edition. This hour we speak to Harris Associates Chief Investment Officer and Oakmark International Fund Manager, David Herro. He's a big investor in European banks getting slammed today. Send in your questions on IB Plus TV Go. Now, first, let's check in on the markets. This is a picture overall for the European Stoxx 600. Now, a lot of indices, including this one, but also the DAX, the CAC 40, actually now falling more than 20% from highs. This is on soaring oil prices, complicating, of course, all of the central bank action, complicating the livelihood of people, and complicating what the banks can and cannot do. Now, there are two things going on with the banks. The biggest losers by far in today's trading session. This is specifically European banks, just because of the exposure to Russian gas. So first of all, it's about the economy and, of course, the impact that cutting off some of the Russian oil would have on those. We're looking at possible stagflation, again, Brent at 139. And then the other ramification is that we're looking at second and third round effects. So Société Générale, also some of the other ones, Crédit Agricole, saying they have this much exposure to Russia and Ukraine. Unclear whether they have to write it off if we see a default, but this is what is making investors run for the hills for the moment. Brent, you can see 126. It was earlier at 139. And the natural gas futures, really the main concern is on how people will heat their, of course, houses as we get into the summer, what this means for inflation, what it means for the cost of living, currently up 48%. So this is a picture across some of the European maps. I think most, if not all, of the indices, if we can get that up for you. Otherwise, I'll tell you about it without looking at it. But this is a picture for the FTSE 100 down 2%, the CAC 40 down 1.6%. FTSE MIB, just because of the Italian bank exposure and the proximity to Russia, is losing the most, down 4.3%. And we are, much like a lot of Asia, into bear territory for a lot of these indices. Now, the U.S. considering a possible ban, and that's where it starts, of Russian oil imports to tighten the economic squeeze on President Putin. U.S. Secretary of State Antony Blinken said a discussion is underway, while also making sure that there's still appropriate supply of oil.
We are now talking to our European partners and allies to look in a coordinated way at the prospect of banning the import of Russian oil while making sure that there is still an appropriate supply of oil on world markets. That's a very active discussion as we speak.
Well, for a roundup of the energy markets reaction, let's bring in Bloomberg's executive editor for Energy and Commodities, Will Kennedy, for an overview of the state of war. We're joined by our European correspondent, Maria Tadeo, and my co-anchor, Tom McKenzie, is outside Chelsea Football Club to discuss the end of so-called Londongrad. So, Will, let's start off with you. If you look at the Bloomberg scoop, this would be a unilateral oil embargo, possibly without allies. And this would be, of course, it would change everything.
Well, it would be unilateral, and in fact, that unilateral embargo wouldn't have a huge effect on oil flows. The US is a relatively minor importer of Russian oil, but what it does do is it makes the whole oil market concerned that sanctions are ratcheting up, that the US, which obviously controls the financial system, is got its eyes on Russian oil, and that European allies are likely to follow suit. So it's going to increase this nervousness that we've seen, this reluctance to buy Russian oil, and it's an extremely bullish development for the market.
Maria, we're expecting a new round of talks. Will they bear fruit?
Well, Francine, what we've seen is that round one and round two did not really produce anything. And of course, the ceasefire was broken a number of times over the weekend. And today, of course, the Russians, who I believe are now on their way to the talks, continue to say we have military goals and strategic goals we want to accomplish in Ukraine. So the talking points have not really changed. If anything, they've hardened over the past week. The other thing I would point to, Francine, just very briefly, we know that Tony Blinken is in the Baltics doing a tour with the 3 leaders of the country. He was also in Poland. And going back into the oil conversation, you know very well on Friday, the Lithuanian president told us we should ban anything that comes with a price tag on Russian energy. And the Polish prime minister was very vocal too on Friday, saying, for me, the fact that we continue to do business with Sberbank and Gazprom is just completely unacceptable. So you see that he's going to hear a lot of voices in the store that are also pushing to fully ban any energy that comes out of Russia.
Maria, thank you. Tom, how aggressively has the UK gone after Russian oligarchs?
Well, certainly the war in Ukraine has really sharpened the focus on the depth, the extent of the Russian money in the UK economy and the political influence as well. So far, the UK has sanctioned 11 Russian oligarchs. That's fewer than their counterparts in Europe and the US. Roman Abramovich, the owner, of course, of Chelsea Football Club, he has not been sanctioned. There are calls for that to happen. We know that he's looking to sell the football club. Also, we are hearing reports he's looking to sell a number of his properties in London as well. You called it Londongrad, Moscow on Thames as another moniker. That is, and that points to the extent, again, of that money in the UK system and the pressure now on the government to unwind and unpick some of that given the war in Ukraine. And that brings us to the economic crime bill that the UK government has fast forwarded and put in front of parliamentarians, and that will happen later today. They say that will give them the tools to go after Russian money more effectively.
Tom, thank you so much. Well, could we see oil at 185? It's currently 139. And if you're an investor today, or if you're an analyst, what do you look at?
Well, I think that there are a lot of people who feel that if we do get a complete or more broad embargo on Russian oil, you know, that's 5 million barrels a day that could be a large chunk of 5 million barrels a day that could be denied to the market when it could least afford it. You've got OPEC not raising production. You've got Libya production faltering. The price can go a lot higher from here.
Well, what's happening right now? So do the world leaders, and especially Europe, you know, call some of their allies and saying, can we buy oil? Like, how does it work? If we're shutting off Russia and it's 40% of what we import, what's the solution?
We're seeing some very interesting moves. We reported yesterday that US officials have started talking to Venezuela, clearly a country which have very poor relations but could provide more oil. There was a report that Biden may considering a visit to Saudi Arabia. Clearly, there's a lot of activity going on to try and secure oil from elsewhere, but it's going to be very, very tough.
Okay, thank you so much for joining us, Will Kennedy, Maria Tadeo, and Tom McKenzie. Smart Conversations continue on Bloomberg Surveillance Early Edition. This hour, we speak to Harris Associates Chief Investment Officer and Oakmark International Fund Manager, David Herro. You can send in your questions on IB Plus TV Go. This is Bloomberg.
Extraordinarily strong report.
Clearly a very strong report across the board.
We're not talking about the payrolls report.
Market reaction is about Russia-Ukraine.
The escalation is more likely than a de-escalation. The war in Ukraine is going to have some impact.
A negative supply shock.
Another risk of supply chain disruptions.
The U.S. economy right now can absorb what's going on in Ukraine.
It puts the Fed in a difficult position.
It's going to be a very delicate task of policy to try to contain inflation.
The Fed was going to be very slow and very deliberate and very open in how it's gradually moving monetary policy to try and reduce any uncertainty coming out of this.
A pretty tough landscape for the market at the moment.
Well, some of our guests are weighing in on the bumper payrolls report, Ukraine concerns, and the Fed. Major stock markets across Europe falling more than 20% from highs. This comes as soaring oil prices are fueling concerns that high inflation will hurt economic growth. I guess it puts the possibility of stagflation really at the forefront. European stocks being slammed, banks losing the most than anyone, down some 5.3%. The CAC 40 down 3% overall. It's very clear that we're now in a bear market. Stocks are selling off globally as oil trading at $130 a barrel amid reports that the U.S. is also discussing a ban on Russian crude. Where we go next, it's difficult to say. Of course, we'll keep a very close eye on any of these market reactions. Now, we're joined to talk about the markets and the economy by Gilles Moët, chief economist at AXA. Gilles, I think the market is trying to weigh through some of the sanctions, some of the secondary and third round effects. What's your biggest concern at the moment? Is stagflation just much more likely?
No, of course, yes. I mean, the day after the Russian attack in Ukraine, we did a very simple simulation, which was based on, oil prices going to $125 per barrel, gas prices, which matter more actually than oil for Europe, going to 125 euros per megawatt hour. And that gave us, in a pretty conservative way, a shock on GDP over 2 years of more than 1%, with inflation higher by more than 1% as well. Obviously, you've seen the data this morning. We've got much further than these assumptions. So the loss in GDP and the acceleration in inflation that we can expect for 2022 and possibly 2023 is going to be very significant. Yes, that's now obvious.
But Gilles, so we have a good chart looking at U.S. financial conditions, and actually it's very clear that they've tightened considerably. We already started looking at that at the beginning of last week, but they started tightened considerably in the last few days. So how do you weigh up the risk of stagflation?
What has been surprising so far actually is that the reaction of the credit market has not been that massive relative to previous moments of geopolitical tension, and that might be actually the next leg, or at least the next area of focus. So far, a lot of the shock has been concentrated on equity, not that much on the credit market, and the credit market matters a lot for financial conditions in general. So that is what I'm really focusing on right now. The possibility that we go further into this segment of the market.
What does it mean for what happens next, Gilles? If we look at fiscal stimulus, what does it mean for what the economy can withstand and the resolve of leaders to actually put in place fiscal support?
Well, focusing on Europe, I think we will see, and we've already seen actually, fiscal stimulus being put back on the table. Italy has provided a shield to households to the tune of 8 billion euros. It's more relative to the increase in electricity prices in Italy, but we'll probably see more of that. The difference, I would say, with the situation in which we were at the beginning of the pandemic is that obviously inflation has been creeping up now for a while, and there might be limits to what the ECB in particular will be ready to do to accommodate this new episode of fiscal accommodation. So as much as I expect the ECB this week to sound dovish and to slow down its process of normalization, I will be very, very surprised if we had the same amount of support that we had 2 years ago.
Gilles, talk to me a little bit about what it means from a financial perspective. So is there a danger that the markets freeze up or seize up? And how is this similar or dissimilar to what we heard from COVID? Should we look at this more through the lens of 2008 or what we just saw at the beginning of the pandemic?
No, for me, in terms of liquidity management, it's more about a 2020 situation, and I would say that relative to 2008 anyway, the financial system has changed enormously, and the reaction function of central banks has changed a lot. If we were to see in the next hours and next day signs of proper dislocation in the market, liquidity risks, and so forth, I have no doubt that the central banks would intervene much faster than they did in 2008. So for me, it's closer to 2020. The problem, though, as I said, is that we may have a short-term reaction to protect the market from the worst of seizure, if you want. That is within the purview of central banks, and they still have the capacity to do that. What is more complicated is how to provide support in the next 3, 6, 9 months when the impact of all this is going to be really visible for the man on the street. On this, I really think we don't have the same capacity than we had.
Gilles, Bloomberg Opinions, John Authors has a piece out this morning, which is the first thing I read actually when I wake up. Always very bright and very timely, entitled Weighing Up Risk of Stagflation Armageddon. In it, he says that the invasion of Ukraine puts in play a world from the past that many investors much under 50 have not experienced before. What are the fault lines in terms of understanding what we're dealing with? Where do you look at first?
For me, the key is in this fiscal / monetary nexus. I'm above 50, so I was schooled into looking into the 1970s for immediate economic history, and what explains a lot of the persistent stagflation in the 1970s was the fact that we had a very accommodative fiscal policy at the end of the 1960s, early 70s in the US, which had been actually enabled by monetary policy. The big difference is that in the 70s, the labor market was much more rigid than what it is today. So you had massive wage indexation systems which have completely disappeared right now. So I would be less worried about the sort of second round effects going through wages. However, I think that this memory, if you want, of the early 70s will loom large for central banks. They won't want to repeat that mistake of the early 1970s. So I think we would be wrong in expecting too much from the central banks right now. They will want to avoid inflation expectations to be completely de-anchored.
Gilles, thank you so much. As always, Gilles Moec, their chief economist at AXA, joining us on this huge markets day. We've never really seen anything like it in the last couple of decades. Smart Conversations continue on Bloomberg Surveillance Early Edition this hour. We also speak to Harris Associates Chief Investment Officer and Oakmark International Fund Manager David Herro. He owns a big chunk of a lot of the European banks. It'll be really interesting to see how he looks at this. Send in your questions on IB Plus TV Go. This is Bloomberg. We're seeing a European stocks rout reaching some bear market proportions. So let's bring in closely the markets to see exactly what we're seeing. It's been a pretty wild ride since the start of equity trading. It's also driving a delineation between two key value sectors. Energy and banks definitely benefiting from gains in value stocks. Through mid-February, they were the two best stocks 600 performance. If you look at banks, on the other hand, today, they're really being pressured by the Russia exposure, falling bond yields and economic uncertainty. And we don't know how that will play out into monetary policy. Now let's get straight to Livia Paggi, head of political risk at JPW, who's been advising investors on how to navigate sanctions and extricate themselves from Russia. Well, JPW argues that aside from the reputational damage, of course, it's become untenable for Western companies to continue to do business in Russia. Livia, thank you so much for joining us. When you freeze the 11th biggest economy in the world, of course, this is going to have second and third round effects. How long will it take for those to play out?
So absolutely. Companies right now, we started off advising them how are they going to navigate sanctions. And then suddenly, over the past week, we're looking to advise them how are they going to extricate themselves from a very complex situation where there's all sorts of regulation now that's targeting foreign investors. Most notably, Putin has said that he's going to be putting a potential ban on foreign investors selling their assets. So it's becoming very unclear even what the timeline is to get out of the country and what would be, how would they do it? So, Livia, there are a number of bondholders, right, that are looking to see whether they get paid for the Gazprom bonds, you know, some of the coupons. There's not, Rosneft, I think, was yesterday, so paid today. Gazprom is today, so paid tomorrow. I mean, it's unclear. There's something about that. Russia does not want to default, I guess, but they're also doing a list on if you're from an investor from a sanctioning country, then you go to the bottom. That's right. So at the moment, we've seen it. This is full economic war, and Russia really needs hard currency and technology at the moment. And we've not really seen any form of repercussions that are deterring Putin. He is putting the Russian economy at the top. He has basically said, we do not care about the international order. You have frozen our central bank, where you sanctioned our central bank. We're going that far. I do not expect him to play ball or, you know, any of the rules that we've seen previously, even related to bondholders necessarily. So what does it mean that a default in either a Russian corporate or a Russian sovereign is inevitable at this point? It's very difficult to know at this point, but it's all possible, I would say. Certainly companies right now are really struggling, and he is putting them in priority, and certainly it is a form of retaliation to defend themselves. So, Olivia, if you look at the second round and third round effects, how long does it take for this to be worked out? I know some of the banks today are being slammed down 9%, down 10%, also because of direct exposure in terms of commercial loans to Russia.
When do we find out how far this extends?
I mean, it could be a couple of weeks. I mean, it depends also, there's talks of possibly a ceasefire taking place, although I'm not very optimistic about that. So it could really depend also whether there's any form of negotiations that take place or whether we're going to see more sanctions rolled out, which there are talks of. Obviously, the U.S. has mentioned that they're looking at possibly doing a ban on oil imports. That would already further aggravate the situation and escalate tension. So I think it very much depends on some of the events that play out over the next few days.
So, Olivia, what does it mean if you're an international creditor or an international investor? I mean, I guess you just have to stay put at this moment and see where the knife falls.
Absolutely. So they're staying put. They're looking at possibly how, our corporates, our clients right now are looking at who they could sell their assets to, which is a huge problem because of the sanctions. They won't know if there's even any potential buyers. They're looking at possibly how they can navigate the situation, also get their staff out. So they're operating on a number of different levels. But at the moment, they are staying put a bit, waiting to see, but also trying to make sure that their staff are safe. These are what our investors are worried about at the moment.
Olivia, thank you so much for joining us. Olivia Paggi, there, head of political risk at JPW, joining us this morning. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. Up next, we speak to Herro Associates Chief Investment Officer. We talk about the banks. Of course, energy and banks are diverging as European stocks are entering this bear market. If you look at the European stocks route, it's reached this bear market proportion. It's driving a delineation between some of the key value sectors. So we'll have plenty more on that shortly. Send in your questions on IB plus TV Go. This is Bloomberg. The U.S. could go solo in banning Russian oil imports. The Bloomberg report on a potential Russian embargo sends shocks through markets. The stocks rise. They do. Putin repeats the war in Ukraine won't end until his demands are met. A third round of talks may happen today. And staying with Bloomberg Surveillance Early Edition, up next, we speak to Herro Associates Chief Investment Officer and Oakmark International Fund Manager David Herro. You can send in your questions on IB plus TV Go. So good morning. It's Monday morning. Welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Markets on a tear. Markets volatile. Markets trying to figure out the bottom when it comes to where you reprice banks. It's extremely clear that Crédit Agricole, joining other European lenders, and now detailing some of their loans and other commitments to Russia and Ukraine, saying that it has exposure about 6.4 billion euros. Now, if you look at what that means, oil soaring, jumping as much as 18% in the early session. This means that it will be a lot more difficult for some of these European stocks to find a bottom. So we're trying to weigh up exactly what it means for the commodity prices. For the moment, much has happened in the past week, but the bloodbath that we're seeing, of course, being shed in Ukraine translates into much firmer sanctions, also possibly from the U.S. That possibly translates into the greater risks of stagflation. European banks down 5%, the CAC 40 now in bear territory, down 3.4%. It's just the commodities and the miners that are gaining in today's trading session. The biggest question is how high can they go? So the U.S. considering a possible ban on Russian oil imports to tighten the economic squeeze on President Putin. The U.S. Secretary of State Antony Blinken said a discussion is underway while also making sure that there is still an appropriate supply of oil.
We are now talking to our European partners and allies to look in a coordinated way at the prospect of banning the import of Russian oil while making sure that there is still an appropriate supply of oil on world markets. That's a very active discussion as we speak.
Well, to talk about the situation, to talk about banks, so let's get straight to David Herro, Chief Investment Officer for International Equities at the Chicago-based asset manager Herro Associates. David has managed his flagship Oakmark International Fund since 1992. The $23.4 billion fund's top holdings include Bayer, Lloyds Bank, Credit Suisse, Glencore, and Continental. And we are delighted that he joins us here in the studio. David, thank you so much for joining us. I imagine a lot of your time is now talking to the banks. I know you're also a big holder of Intesa to try and figure out the third round effects, but also just the direct exposure a lot of these banks have for banks. What have you found?
Yeah, well, actually, the biggest effect so far has been with the lower interest rates and the higher bond prices in Europe and the U.S. This has had a negative sentiment for the banks. So you've seen an extreme price reaction. In fact, there was some brokerage research out last week that showed this period since the invasion, you've had an equivalent price movement as you had in the pandemic. And recall that a lot of this was well overblown because you didn't see this huge credit losses in these things that fundamentally hurt banks. So banks' assets are loans, and what really makes a bank unvaluable is really a decrease in credit quality.
But David, I mean, there are also some banks that have direct exposure to Russia. I'm thinking of some of the Italian ones, some of the French ones. Do you own any of them, and what does it mean for your investments in them right now?
They do have some direct exposure, and for what we've seen, this direct exposure for a bank like Intesa, which we own, is literally around 1% of its market cap. So this is not 10, 15, 20, 25%. This is a very tiny, tiny portion. Same with BNP. So at this stage, the bigger impact causing the lower prices, I believe, has been the weakening of interest rates and the increase in bond prices. I mean, yes, there is exposure, but it's relatively small.
And so, David, some of these banks, including Intesa, of course, and Unicredit, have a big dividend policy. You don't think that's put at risk at all?
Well, so far, I don't believe so. I mean, they all have excess capital. This has been the story of the last decade, has been a massive capital build of global financial institutions, of European financial institutions. I mean, we've gone from 4, 5, 6% Tier 1 capital to 14, 15%. So you've had this massive capital build. And at this stage, they're all in a position of surplus capital. And as you know, they've announced increased dividends and stock buybacks. So we'll see what happens there. But their capital position is extremely strong. And it seems investors are going back to the 07, 08, 09 playbook when they were 10 years behind. And now, of course, we're in a whole different situation.
On Credit Suisse, and there are many questions on Credit Suisse not related to this, but if we just stick with the Russia situation for the moment, when you sanction billionaires, how much does it hurt some of the wealth management?
Yeah, it will hurt some, and we also own stock in Julius Baer, and UBS has the same thing because there are rich Russian oligarchs and what have you. And it's still somewhat unclear, but all these banks have announced certain actions against their Russian client base. So I can't imagine overall it's positive, but again, given the relatively smallish portion they represent of total wealth, it shouldn't have a huge effect.
David, so you're a huge holder in some of these companies. I don't know if we have a stock board, which we're looking at just moments ago. Do you buy stock if a bank that you think has good fundamental value longer term falls 8, 9%? Or do you have to see how it plays out in terms of the possibility of stagflation, especially in Europe?
Yeah, well, our mechanics are as follows, as to whether add or to subtract from a position. So step one is to determine the value of the business, taking all the fundamental information, all the stuff that's going on in the environment, and try to impute what these actions have on the value of the business. And if the share price is down 20 or 15 or 25%, and we can't come up with anything close to that in terms of the impact on the long-term value of the business, then to us it becomes an opportunity. The reverse is true for something that may have spiked up for short-term reasons, and we can't really increase the underlying intrinsic value of that company, then it becomes a trim. So as you can imagine in some of these financials, I mean, I truly believe that if you look at their medium and long-term prospects, notwithstanding the short-term uncertainty, this begins to have an opportunistic feel to it.
Right.
Now, you can't just rush in and spend all your excess savings and assets into these things, but certainly at these levels, they're extremely attractive.
So what is attractive in particular? Would you add to Intesa?
Well, the European financials almost as a basket, and I look at our high-quality European financials like Intesa, like Allianz, like BNP, and even Credit Suisse. Lloyds Bank in the United Kingdom, I mean, has really gotten hit. It was trading over 50 pence, a couple weeks ago. And
you don't have Unicredit.
We don't have Unicredit.
Would you buy into Unicredit at these levels?
I think it's got caught into the same situation. Now, I believe they have a little bit more Eastern European and Russian exposure. I don't know it as well as the situation had as Intesa, but this basket has just been slaughtered, and I think to some degree that it's well overdone.
I should know this. You didn't have any Russian exposure to banks, right?
Zero Russian exposure. You know, we've always had a policy of when we look at places to invest, if we don't feel there's a legal framework, if there's protection for investors, et cetera, then it becomes uninvestable. And under those criteria, Russia has never made our investable universe.
Is there something systemic that makes you worried about liquidity or some of the markets freezing through bank assets?
Yeah, we haven't seen this yet. I mean, so far you have seen the ability to clear transactions. Of course, unless it's the Russian counterparty, that's a different story. But I think right now there appears to be more than adequate liquidity.
Where's the biggest fault line that we could see? Again, if you look at some of the, Credit Suisse, this is a 1 year 49%. This also has very specific Credit Suisse concerns. But what do you do with Credit Suisse?
Yeah, of course, Credit Suisse has had other issues in terms of what happened last spring. And then, of course, there was the change in the top leadership of Credit Suisse. But we believe that those factors that caused the issues of Archegos and the supply chain funds, the compliance issues and the risk control issues have been dealt with quite aggressively at Credit Suisse. And I think this is one of the positives, is that they have instilled new procedures and installed new people. And whether it's a new chairman or an old chairman, what we've had has had major changes in how Credit Suisse operates.
So you're sticking with it?
We've stuck with it, yes.
Okay, David, we have many questions from viewers, so thank you so much for writing in. This person's writing in, David, and they say, how does one mark-to-market assets that are frozen under extenuating circumstances like an international conflict, and what if they come back?
I think in the worst case scenario, if you have assets of something that are being sanctioned, you mark them at zero. And then if they come back, they come back. It's very similar during the pandemic when banks took huge charge-offs, huge provisions. Now, eventually they rewound those provisions. When the worst case scenario didn't appear, then banks wrote back the provisions they took.
Right.
But I think it's best to be conservative. Now, again, these types of credits represent a tiny amount to the European banks, most European banks. There might be some obscure bank out there that has gone, ballistic in lending to these credits. But I think if you have them, you mark them at zero.
All right, David, thank you so much. We'll have plenty more, of course, on that. And I want to talk to David Herro about the energy space as well. He's from Harris Associates. Now let's get back to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. A decree signed by President Vladimir Putin will allow Russia and Russian companies to pay foreign creditors in rubles. The decree establishes temporary rules for sovereign and corporate debtors making payments to creditors from countries that, quote, engage in hostile activities against Russia. Russian corporate bonds denominated in foreign currencies have plunged to deeply distressed levels in recent days as investors do weigh the impact of sanctions. Now, China's targeting GDP growth of about 5.5% for this year, at the higher end of many economists' estimates and quicker than the 4.8% expansion forecast by the International Monetary Fund. Beijing is expected to stimulate the economy, loosening controls on the housing market and increasing infrastructure investment. Officials, though, have also vowed to keep total debt levels in the economy stable this year. And a teenager from Florida who soared to fame tracking Elon Musk's private jet is turning his sights on the yachts of the Russian billionaires. Jack Sweeney started tracking the aircraft of Russian oligarchs at the end of February. He is now following their yachts as tycoons come under pressure following Russia's invasion of Ukraine. Sanctions on Russia's elite are seen by many as a way to target President Vladimir Putin, who counts the billionaires as part of his very own inner circle. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Coming up, KPMG and PwC join Netflix, Visa and MasterCard in suspending operations in Ukraine. We'll take a closer look at the corporate fallout. Also, major stock markets from Europe to Asia heading for bear market, falling more than 20% from highs amid fear of inflation shock as crude oil soaring on the prospect of a ban on Russian supplies. We'll have plenty more on that with David Herro. This is Bloomberg. Now, for more on the fallout from the war on corporates and the exodus from Russia is becoming more of a rout. For more on this story, we're joined by our Danny Berger. Danny, what exactly is the current state of corporate response to Russia?
Well, the list just keeps growing of those that are cutting ties with Russia. It's growing in size and also spanning more and more industries. Over the weekend, we heard from more tech firms that are stepping out of Russia, Netflix being one of them, saying that they're shutting down their operations there. They're also not taking on new customers. Unclear what happens to existing companies. TikTok, also another to shut down operations there, citing the new fake news law from Russia that's aimed at silencing dissent. MasterCard, Visa, so the card makers, two of the four big accounting firms also stepping back, PwC and KPMG. And then at the same time, some of those big oil companies, that's been really in focus. Of course, they've stopped their joint ventures, but we do have them still trading somewhat in the region, Francine.
All right, Danny Berger there with the very latest. Major stock markets from Europe to Asia now heading for a bear market, falling more than 20% from highs. We're back with David Herro from Harris Associates. David's told us before the break that he has zero Russia exposure. David, I guess the concern is that if there's something that turns ugly on the stock market, so default, either on a corporate or also on a Russian sovereign, I mean, the chances seem pretty high given how it's all unfolding.
Well, I think, yes, if you have a Russian debtor, you're in trouble.
No.
I mean, because the West is going after the Russian economy, which, by the way, eventually will make it difficult to wage a war. I mean, if you have all these simultaneous attacks on the Russian economy, that can't be good. Now, don't forget, Russia had its problems back in '98. The same thing happened. Yeah.
But it was a smaller economy in '98, and it was less interlinked with the rest of the world.
Yeah. Well, and it's still a relatively small economy. Let's not, overstate the importance of the Russian economy to the world. Yes, Russian energy is important to the world and resources. And in fact, even there's 8 or 9 surplus barrels that Russia exported. The world energy demand is 98 million barrels, so you have 7, 8, 9%. And if the West committed itself to producing more oil, which in places like the United States, it can, instead of begging to Saudi Arabia and Venezuela, as we've seen in the last few days, this would mitigate some of this 7 or 8% that Russia adds to the global market.
Are you buying energy stocks? So I know you have a big exposure to Glencore. Will you add to that?
We own Glencore, yes, and Glencore has become even a larger position, of course, because it's gone up in the period where the rest of the portfolio has gone down. So it's become a much larger position. It was already a top 10 name. It's probably our number 2 or 3 name in most portfolios, as it's done quite well. Why is it done quite well? Because it's exposed to such things as copper, nickel, and coal. People forget that the price of coal, a few years ago, seaborne coal was $50, $60 a ton. Today it's at what? $400 a ton. Now, you have to balance that with some of the ESG concerns that some have had, but I think, at least in the short term, the objective for ESG concerns should be S.
But David, there was a Bloomberg scoop saying that actually the U.S. could look at unilaterally putting an oil embargo on Russia. Europe is 40% dependent on gas coming from Russia. What happens in this scenario?
That gas would have to come from somewhere else, and excuse me, I think this is why it's difficult to just cut off Russian gas to Europe, because you got to get it from somewhere. It's out there, but it's going to take a while to transport it.
Let's look at financial conditions. And they've been really tightening in the U.S. This is one of the biggest stories. And of course, it means that if you're a central bank, how do you look at this? What do you look at? And can we, at this point, actually avoid stagflation?
Well, there's something else you can do, of course. You have this dependency on European gas. You have to look for other ways to substitute gas. And unfortunately, it's either coal or nuclear or these types of things. Now, Germany, of course, is winding down and shutting down nuclear power plants. Elon Musk suggested this should be stopped and unwound and restart the plants. I mean, there are ways you can limit your dependence, this 40% dependency. You're not completely helpless.
But David, it's a problem of timeline, right?
It's a problem
takes
of
1,
timeline.
2, 3 years, even 10 years.
Well, the switch from natural gas to coal and power plants doesn't take 2 or 3 or 4 years, especially since
6 months?
they mothballed. Probably even less than that. I mean, they could probably start some of these up in a couple months. I mean, we've heard stories on how some Italian power plants are now switching back to coal.
Yeah.
And so you might have to live with, from an ESG perspective, a tougher E but a better S by switching back to coal. And I know this sounds blasphemous, but what you have to do is what you have to do.
I mean, does it depend on the price of oil and gas? And could it reach 185? I mean, in your models, how do you look at, peak panic or...
Yeah, you still have to look at in our models and why we have trouble investing in oil and gas today is we don't take today's price and normalize it. Today is a special situation. Yes, it can even go higher, but fundamentally, if you look at the world's supply of oil and gas, other than what's happening in Russia, the picture isn't so dreary. The U.S. has all kinds of opportunities to increase production if the regulators and the policy prescribed as such. There's still excess capacity. There's a question how much excess capacity in the Mideast and in Saudi Arabia. So there are opportunities. It's not like the world is there's no oil anywhere. It's that the oil, the 7 or 8% that is contributed to the global oil trade from Russia is going to have a question mark around it.
Yeah, and all of the uncertainties in the meantime. David, as always, thank you so much for joining us. David Herro, Chief Investment Officer for International Equities at Harris Associates. Now, coming up, the UN says refugees are moving through Europe at the fastest rate since World War II. We look into the unfolding humanitarian crisis. This is Bloomberg. More than 1.5 million people have crossed from Ukraine to neighboring countries in the past 10 days. The UN says it's the fastest growing refugee crisis in Europe since World War II. Now let's get the latest now with Piotr Skomliński, Bloomberg's Warsaw Bureau Chief. Piotr, bring us up to date, first of all, with the latest refugee situation in Poland.
Hi, indeed. So yesterday we crossed another milestone, which was 1 million refugees actually crossing over to Poland since the war started. And the daily numbers are really going up. We also had 150,000, almost as many of them just in one day. And just to give you a sense, only a week ago, the government was saying we're expecting 100,000. So the numbers are really, really going up. And so far, the response from the population, from the people on the ground here has been quite tremendous. So there's a lot of self-organization, NGOs, people just jumping in and helping. People mostly accepting refugees into their homes. We're seeing that. And you have to remember that there's a big diaspora of Ukrainians here. So partly these are also Ukrainian families accepting the loved ones who are coming to Poland to settle in. And also what you're seeing is that there are gyms that are being converted into shelters. So there's a big response from the Polish side.
Thank you. Thank you, Piotr Skomliński there, Bloomberg's Warsaw Bureau Chief, and we'll have plenty more, of course, on some of the packages. More Bloomberg Surveillance Early Edition up next. This is Bloomberg.
We're really closely, monitoring the situation.
There'll be a lot more companies in America, and not just America, around the world, will be taking steps like this against Russia.
They're delivering a real jolt to the Russian economy, and they're delivering a real jolt, especially to those close to President Putin.
We're coordinating our response accordingly, but we know that there's some uncertainty as we go forward. The question is, how long will Putin continue this war?
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Monday, March the 7th. Our top stories today. Oil shock. Brent and WTI soar as the U.S. considers a unilateral ban on Russian oil imports. The stakes rise. Putin repeats the war in Ukraine won't end until his demands are met. A third round of talks may happen today. And the view from Beijing. China declares its ties with Russia to be rock solid. We get the latest from China's National People's Congress. Welcome to Bloomberg Surveillance, everybody. This is the early edition. I'm Anna Edwards in London with Kailey Leinz and Matt Miller over in New York. And Kailey, certainly a big focus on commodities, a spike up in many commodities this morning, certainly taking the edge off European stocks and sending them substantially lower.
Yeah, what we're seeing in commodities is really rippling through asset classes across the board, Anna, and that was definitely true in Asia overnight. Broad down day for Asian equities. The MSCI Asia Pacific Index falling 2.8%, putting it in bear market territory, down more than 20% from its record high in February of last year. You had a lot of the regional gauges, Hong Kong, China, Japan, all lower by 3% or more. And it was actually Hong Kong that was really the laggard within that, partially due to the massive declines we saw for technology. That Hang Seng Tech Index down about 4.4%. But in terms of the reaction we're seeing in other asset classes and FX, I would point to the Indian rupee. Of course, India is a major oil importer, so higher oil prices can hit that economy incredibly hard in particular. So the Indian rupee is actually at its weakest against the dollar on record, right now trading at 76.97 or so. And then finally, I would point out it's not just oil where we're seeing moves in the commodity complex. It's really across the board. That also includes iron ore futures up 4.5% in Singapore, though that partially has to do with what we got out of the NPC out of China over the weekend, Matt, and that 5.5% growth target for this year. So that's lending the idea that we'll see higher demand for iron ore.
Yeah, and we're going to talk a lot more about what's going on out of China. But of course, Ukraine is front and center with Russia's war there. You see S&P futures down right now 1.5%, and these losses, I should say, could accelerate as we get closer, of course, to the open, especially considering what we're seeing out of Europe. Money flooding in to the dollar. You can see the Bloomberg Dollar Index now over 1,200. And a lot of these moves, it's not the size of the move, but the level that we've hit that I think is so interesting. For example, I've left Bitcoin out. It's down more than 2%, but only to 38,000. That's a number we've seen a lot lately. We haven't seen $122 on West Texas Intermediate crude lately. I mean, this is amazing, the march higher. And, of course, we saw it even bigger overnight with Brent as well. And gold at a level of almost $2,000 now, $1,997, up 1 1/3%. This really shows the search for safety. Investors are looking for any haven in this storm, Anna.
Yeah, absolutely. And whilst we were sleeping, we saw gold go over $2,000 a troy ounce. More on that in a moment, more on the commodities that Matt was rightly pointing to in a moment. But this is the picture across Europe. It's red across Europe. And if you can get a sense of any of these percentages, down by more than 3% on the German market and the French market, down by more than 3% in the periphery in the south, but we were down by more than 5% on some of these Italian and Spanish, on the Italian and Spanish markets earlier on in the trading day. A lot of the focus is on the banking sector today. Not many sectors in positive territory. Some of the energy names are moving higher, but we do see a lot of pressure on the banking stocks. At one point earlier on today, there were more than 10 banks across Europe in the Stoxx 600 that were down by 10%. So we certainly have seen some substantial moves to the downside. Some of those losses have been paired just in the last hour or so, but certainly some pressure on the banking sector here in Europe, down by nearly 5%, as you see there. This is the other side of the euro dollar right now. So the euro down 0.7%. Of course, the story is really just flying into the dollar. It's the haven of the dollar that is winning out right here. We saw the euro go through parity with the Swiss franc. A lot of people talking about whether we will hit that on euro dollar as well. Now, more on that later. Brent crude 125.08, up by 5.9%. But again, whilst we were sleeping in European hours, 139 is where we got to on Brent. So we've seen incredible volatility on the oil price overnight, and another surge upwards in natural gas futures. This is the European benchmark, the UK benchmark also soaring. This one up 38%. And I remind you, this is just an on-the-day move. move, taking out incredible levels on natural gas prices. And this is where the tension really lies as we see the politics play out in the United States. Where will that leave Europe? What role will Europe play, and how high will these energy prices go? Kailey?
Yeah, it is definitely a wild day for so many asset prices, Anna, and it is going to be as well a busy week ahead, so buckle up. First, we have South Korea holding its election on Wednesday as President Moon Jae-in's 5-year term comes to an end. It's going to be a big day on Thursday. First, we'll get the ECB rate decision, and then we'll also get the all-important U.S. CPI reading later on that morning. You also have EU leaders meeting in Versailles on Thursday and on Friday, and finally, China's National People's Congress that started over the weekend will be continuing all week, Matt.
All right, now let's get back to Russia's invasion of Ukraine as it heads toward the 2-week mark. The stakes for both sides look set to rise. President Putin said again on Sunday the war will continue until Ukraine accepts his demands and halts resistance. Let's get to our reporters around the globe. From Brussels, we've got our European correspondent, Maria Tadeo. In D.C., we're joined by our Washington correspondent, Anne-Marie Hordern. From London, Bloomberg's Danny Berger on the market fallout, and Tom McKenzie is live in front of the Chelsea Football Club Stadium for the latest on UK sanctions. Finally, China's response and the NPC results with Enda Curran out of Hong Kong. Maria, let's start with you in Brussels. What do we know about the progress of Russia's war so far?
Well, Matt, we know that today we're going to see another round of talks. In fact, we're just learning from a Russian news agency, state news agency, the Russian delegation has landed in Belarus. Now, in real terms, we saw that in round 1 and in round 2, not a lot was achieved. And then we saw over the weekend that the ceasefire was broken repeatedly. Now, going into this further round of talks, the Russian president yesterday delivered a message in which he said Russia has strategic and military goals to achieve in Ukraine, and it will continue. Everything is going according to plan. Remember, he refers to a special operation. The word war is now not allowed in Russia. Now, he also continued to say the demands are very clear. Ukraine has to see a change of government. They need to give up weapons and, of course, also give up on their bid for NATO membership and European Union membership. Of course, when you look at what Zelensky responded in Ukraine, well, he said it's a complete opposite. He said we will never surrender, and Ukraine will never forgive everything that Russia has done to our country over the past 11 days.
All right, our chief European correspondent, Maria Tadeo in Brussels, thank you so much. And speaking what we're hearing out of Europe, the EU Commission President Ursula von der Leyen just saying that they are working on further sanctions on Russia. Washington is potentially working on that as well. The Biden administration is considering whether to ban Russian oil imports without the participation of allies in Europe. Antony Blinken, U.S. Secretary of State, spoke on CNN yesterday.
We are now talking to our European partners and allies to look in a coordinated way at the prospect of banning the import of Russian oil while making sure that there is still an appropriate supply of oil on world markets. That's a very active discussion as we speak.
Bloomberg Washington correspondent Anne-Marie Hordern joins us now in Washington, D.C. Anne-Marie, how soon could we see this move?
Well, it's a very fluid situation, and the scope and timing, we just don't have the details yet. But I spoke to a senior European official yesterday and didn't get the sense that Europe was ready to act immediately. But Tony Blinken there, Secretary of State, saying that those conversations are happening, and the U.S. may be the ones to just move first and unilaterally, being the ones to say no to Russian imports of crude oil and other fossil fuel products. Now, the pressure is very much so growing on the administration. Whether or not the administration acts or not, you're likely going to see legislation. That was the tone we saw from a memo to lawmakers from Speaker Pelosi. And really the pressure started to garner a lot of speed over the weekend after President Volodymyr Zelensky of Ukraine Zoomed with a number of lawmakers from the United States saying the pressure must continue on Russia and on those sanctions. Now, the U.S. would be in a better place to shun some of those imports because, as a matter of fact, right now, many refiners are just not taking in those crude imports from Russia. The issue would be Europe. Would Europe be able to do this at some point? That remains a very big question.
Yeah, where that would leave Europe is, of course, a big question. Anne-Marie, thank you very much. Bloomberg's Anne-Marie Hordern in Washington. Let's get more on the Biden administration's potential Russian oil ban and the impact that that is already having on commodities. Bloomberg's Danny Berger joins us with a breakdown. Danny.
And as Citibank has described the war in Ukraine as transformative for the global energy markets and, of course, the sanctions adding to that. And that is the kind of price action that we're seeing today, one that implies not just a transformative event for energy markets, but also for the European economy. And you were showing some of these moves earlier, but I have oil up on the board, up more than 5.5% at its highest price since 2012. Nat gas as well. I do just want to add on this 261 megawatt hours to put this in perspective, because, you know, we often don't really talk about what this means. If you were to translate this into oil prices, according to Javier Blas, this is the equivalent of $450 a barrel in oil. That's how massive this price is in natural gas. Of course, it means a lot for the consumer, too. You have gas, oil also charting even higher, and wheat. Given that Russia-Ukraine wheat output is a third of the world, it has hit its upper limit on prices for the 6th consecutive day. So those up about 7%. Now, this comes at a time when the oil market was already extremely tight. Backwardation, I have a chart up for our radio audience, of the 1st and 6th month of oil contracts. It already was extremely high, but given the anxiety of getting a barrel of oil right at this moment, we're seeing backwardation on this level at the tightest ever.
All right, Danny, thanks very much for that. Danny Berger there looking at the big moves in commodities. Now, the UK has sanctioned more than 100 Russian individuals, including at least 11 of the nation's wealthiest, after Moscow's invasion of Ukraine. The government also under mounting pressure to sanction Roman Abramovich, the billionaire who owns London's Chelsea Football Club. He's now selling the club, as well as other properties he owns in London. Let's get more at Bloomberg's Tom McKenzie, who is outside of the Chelsea Football Stadium. Tom, how aggressively has the UK gone after the Russian oligarchs?
Well, Matt, quite simply, the critics will say not aggressively enough. And the reason we're outside Chelsea Football Club is because, as you say, it's owned by Roman Abramovich, who is really emblematic here in the UK of the Russian money that's embedded itself in the economy and arguably as well political influence. Now, he has not been sanctioned, but he is looking to sell some of his properties here and, of course, the football club with a valuation of about £3 billion. Now, the UK economy, or the UK government, says they are stepping up their game. They're putting forward an economic crime bill to members of parliament today. That would put in place a register that would enforce the owners of these assets, largely property across the UK, to have their real identities rather than hiding behind shell companies. And it's going to go back. It's going to reach back 20 years. So real implications from that. They're also setting up an oligarch task force. And the Home Secretary says she wants to be able to mirror the sanctions that we're seeing in Europe and the US. But we have 11 oligarchs who have been hit by sanctions here, assets frozen, travel bans. That is not nearly as many as have been hit in Europe and the US. The UK government saying this crime bill, if it gets through the Houses of Parliament later today, will give them the tools and the legal framework that they need to be able to go more aggressively and really start to unwind the money that is flooding into the system here in the UK.
All right, Bloomberg's Tom McKenzie out on the street in London for us. Thank you so much. Let's turn now to China, which has declared ties with Russia to be, quote, rock solid despite Putin's invasion of Ukraine. But the foreign minister there has pledged to play a role in promoting talks and keeping the war in Ukraine from escalating further. He spoke earlier.
The situation in Ukraine has become what it is today for a variety of complex reasons. What is needed to solve complex issues is a cool head and a rational mind, not adding fuel to the fire.
But worries about the war overshadowed China's signal that more stimulus is in the cards after it set an economic growth target that topped forecasts. Enda Curran, Bloomberg chief Asia economics correspondent, joins us now for more. Enda, what else have we learned from the NPC over the weekend?
Well, look, two takeaways today, Kailey. On the economy side of things, the government have set a target of about 5.5% growth for the economy. That's considered a bit on the ambitious side. Most economists were looking for a slower pace of growth. It does suggest perhaps some stimulus for the economy, and that might obviously have some modest global spillover effect there. So potentially positive on the growth story. Remember, it's all about stability given the important political year in China. And the other, of course, big takeaway from the NBC was from Foreign Minister Wang. He just played that quote from him. He made the point that relations with Russia remain rock solid. He criticized the US. He accused them of trying to create an Indo-Pacific NATO. He said China is willing to play a constructive role in any dialogue to secure peace. But at the same time, he made it very clear that the bond between China and Russia won't be broken over this conflict.
All right, thank you so much to Bloomberg's Enda Curran in Hong Kong. I want to get back to a few of the specific company stories we're looking at this morning, moving in pre-market trading. We had a lot of companies, a longer list that keeps getting longer, pulling out of Russia over the weekend. That includes the likes of Netflix, as well as a lot of credit card players, MasterCard, Visa, and American Express. MasterCard, for example, gets about 4% of its revenue from Russia. So as a result, all of those stocks are lower in the ballpark of 2 to 3% before the bell. But as for what's moving higher, no surprise, it is basically anything in the energy complex. With the move higher we are seeing in oil, the energy select sector SPDR, which tracks how the sector will do as a whole come the opening bell, is up the better part of 3%. You have Occidental Petroleum up more than 8%, and even big major players like Chevron higher by nearly 3 percentage points, Anna.
Kailey, coming up on the programme, we're going to be speaking to Pascal Blanc, the Amundi CIO. Plenty of news to talk to him about when it comes to moves on the markets. Also, lots of geopolitics to discuss. And we're going to be talking about some of the lines coming through right now from the US Secretary of State, Antony Blinken, commenting in Lithuania. He moves to Latvia, so he's in the Baltics, a part of the world that is very nervous, of course, about what is happening in Ukraine. Blinken saying he is utterly convinced Ukraine will prevail. Some of this conversation feeds in nicely to what we'll be talking to Wolfgang Munchau about, Eurointelligence Director. He'll be with us later on this hour as well. This is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. We are simulcast on both Bloomberg Radio and Bloomberg Television. I'm Matt Miller here in New York with Kailey Leinz. Anna Edwards is out in London. Now, we're seeing insane volatility in these markets, which begs the question, what are central banks to do? I've got a chart here for those of you listening on radio that shows the jump in volatility we've seen in oil, obviously overnight with Brent going to 139. You've seen a huge jump in Treasury volatility with a 10-year back down to a 170 handle. And stock market volatility really hasn't come yet. Maybe that's what we're expecting to see at the open this morning. Ven Ram joins us, Bloomberg MLive strategist out of London. Ven, what do you expect in terms of volatility and the central bank reactions?
Morning, Matt. I do think that volatility is on the ebb, and I think it's going to continue to rise. We've seen, especially at the front end and the intermediate ends of the option volatility curve, it's uncocked a lot this year, and I think that it's going to go higher because of the Brent crude prices surging. And that means that the Fed was already behind the curve, and they are now going to have to do the onerous task of catching up with the markets. They're way behind the curve. It's like they're going to miss the boat on where they need to be on rates, and they're saying that they will walk slowly to get there, and that's not an optimal solution because 25 basis points is not going to check the market expectations on volatility or on inflation expectations. We need a bigger move from the Fed, but I'm not too sure they're prepared for it yet because they don't want to shock the markets, excuse me.
Okay, Ben, yeah, interesting point. That's the Fed. Let's ask you about the Swiss Central Bank because for the very good reason that we passed through parity between the euro and the Swissy. We had a period where there was a peg. The Swiss Central Bank had a peg to the euro. That was abandoned. Are we talking about them possibly bringing it back? Is a strong currency so much of a problem for this economy that that's what they might do?
Absolutely, Anna. I think that there's a distinct possibility that they may bring that peg back, but they introduced the peg in 2011, of course, with putting a floor on the Euro CHF at 120. I do think that that floor is no longer valid, but I do think that they may revisit the floor, albeit at lower levels for the Euro CHF, which may be, my guess is that it would be somewhere around 109. At that level, the Swiss franc would still be overvalued, but the overvaluation would be a lot milder than it is now. And those levels, I think they would be comfortable with. And those are the levels that have prevailed earlier this year. So I do think that 108, 109 is the sweet spot if they have to reintroduce that peg.
Okay, Ben, talking there about the Euro Swissy rate, just to make that clear. Ven Ram of Bloomberg Markets Live, thank you very much for joining us. For more market analysis, check out MLIV Go on the terminal. This is Bloomberg.
Now, now, keeping you up to date with news from around the world. Here's the first word. China reported its highest daily tally of COVID-19 infections since the Wuhan outbreak at the start of the pandemic. The highly transmissible Omicron variant is said to have sparked multiple clusters across the country. The global death toll from COVID has now topped 6 million. Russian forces have stepped up their nighttime shelling of cities in the center, north, and south of Ukraine, according to a Ukrainian official. That comes as an evacuation from the southern city of Mariupol has been stopped for a second day. Ukrainian officials claim Russia has again violated a temporary ceasefire deal brokered to allow the safe passage of civilians. Kyiv and Moscow indicated more talks could happen today. And a teenager from Florida who's shot to fame tracking Elon Musk's private jet is turning his sights on the yachts of Russian billionaires. Jack Sweeney started tracking the aircraft of Russian oligarchs at the end of February and is now following their yachts as Russia's elite come under pressure following the invasion of Ukraine by Russia. Coming up, we'll talk more about the market implications of the war in Ukraine, potential stagflation risk with Pascal Blanquet, Amundi CIO.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Biden administration is considering whether to ban Russian oil imports without the participation of allies in Europe. Oil soared to as high as $139 a barrel after it emerged that the U.S. is weighing a possible embargo of Russian crude, fanning supply fears in an already volatile market. More corporate reactions to Russia. Netflix, TikTok, Samsung and U.S. credit card operators have joined the lengthening list of businesses cutting ties with Russia or reviewing their operations in the country as reputational and financial risks mount. And China declares its ties with Russia to be rock solid despite President Vladimir Putin's invasion of Ukraine. Worries about the war overshadowed China's signal that more stimulus is on the cards after it sets an economic growth target that topped forecasts. I'm Anna Edwards in London. Matt Miller and Kailey Leinz, of course, with me in New York. And Matt, European equity markets off earlier lows, but certainly weighed down by fears about what higher commodity prices really do to the growth trajectory.
Yeah, absolutely. 2, 3, 4% drops for European benchmarks is really shocking, and your eyes are going to be drawn to the commodity prices today. Here is NYMEX crude at $123.27 a barrel, and it's off its highs. So really, it's this massive jump, the huge volatility in commodities that's hit European markets. It's hit S&P futures right now down 1.6%. It's got investors piling into dollar assets. The Bloomberg U.S. dollar index up over 1,200 right now. And it's got investors buying gold, which is over $2,000 right now. The list doesn't stop there. Of course, you can look at treasuries. Investors are buying that. They're selling Bitcoin as a risk asset. So it's really a very risk-off session that we're preparing for today. Kailey, what do you see in terms of the pre-market movers?
Well, that's definitely reflected in the pre-market in that a lot of stocks and a lot of different industries are lower. The one that is outperforming, though, no surprise with the move in oil, is energy. The Energy Select Sector SPDR ETF, which tracks how the sector is going to do come the opening bell here in the U.S. in around 4 hours' time, is up by about 3 percentage points. Chevron, one big oil player, up 2.6%. But as for stocks moving to the downside, a lot of the travel complex is under pressure. That includes the airlines. It also includes the cruise lines. On the one hand, you have concern about what the war may mean for travel demand. On the other hand, higher fuel costs could weigh heavily on the bottom line of some of these companies. So Royal Caribbean, for example, is down about 5%. And finally, we also have a growing list of companies that keeps getting longer, pulling out of Russia. That includes Visa, Amex, and MasterCard. MasterCard is down about 3 percentage points. It has about 4% exposure to the Russian market, Anna.
Yeah, really interesting as those payment companies start to pull out of Russia, Kailey. Businesses, whether they want to or not, having to question whether they want to keep operating in Russia right now. Let's talk about the European story. Matt's been through the futures picture for the US, which does look pretty bleak this morning, and certainly some of that handover coming through from Europe. Although I will say that the Stocks Europe 600 down by 2.4% is off earlier lows. We have been down more than this in the earlier part of the trading session. 108 is the handle on euro dollar. 1% down, a full 1% down on the euro against the US dollar. We've seen the euro take out parity on the Swiss franc earlier on, such as the weakness that we're seeing there and the strength in the Swiss franc. We talked about that with our colleague Ven Ram earlier. And this is the commodities story writ large for Europe in Brent crude and in natural gas. And this is really why we're seeing this weakness in stocks. It's concern about what these higher prices, the pace of these moves to the upside, certainly in the sense in the case of natural gas, 30% higher just in one day. And we've seen this on a number of occasions in recent weeks, of course. What is this kind of inflationary impulse going to do to the European growth trade story. That's one of the big concerns on the economic agenda, of course, away from the war itself, Kailey.
Well, let's talk about those concerns further now, Anna. Pascal Blanquet, chairman of the Amundi Institute, is joining us now. Pascal, we're seeing these moves in commodity prices feeding into this idea of inflation, which in and of itself is feeding into the idea that we may be heading for a growth slowdown. Is this going to be a stagflationary environment?
Yeah, I think it's an additional step on the road back to the 70s. I think basically with stagflation, the main risk embedded in the new regime. And for investors, it means that the new game in town is to preserve the purchasing power of the portfolio per unit of risk, trying to search for sources of positive, lasting real returns, or getting an exposure to what is positively correlated to inflation.
Pascal, good morning. I wonder what you make of what we're seeing in the banking sector here in Europe today, and whether you think it all looks orderly and as expected. We've seen some banks coming forward with numbers and saying, look, our exposure to the Russian market is X. The market not necessarily focused on that, though, thinking instead about what higher commodity prices do to the growth outlook and other transmission mechanisms, perhaps, between Russia and European banking. Are you concerned about the European banking sector?
Not necessarily the European banking sector, actually. What we are seeing is a sort of price discovery process, actually. And it's an exploratory approach in the markets, trying to get a sense of what's going on, what are the channels of transmission. It's seen today as a sort of... European assets are seen as a sort of a falling knife, actually. We are not that far from capitulation across the board. And we've seen a sort of global risk premium built into European assets in relation to the Russian attack. So this is where we stand at this point, with little discrimination at this point, and markets in a sort of price discovery process mood.
Okay, so too little discrimination, maybe what we're seeing in that sector, or maybe even beyond. You mentioned going back to the 70s as a sort of reference point, Pascal. How similar is this going to become to what we saw in the 70s in terms of a spike higher? We're seeing one right now, aren't we, in energy prices?
I think there are common points with the 70s. Energy is one, actually, but generally speaking, I think that what we are seeing is a regime shift, and by a regime I mean a broad set of macro financial features. Inflation is one. Mandates given to institutions. Central banks are no longer the central banks we used to know in the 90s. Let's say they are on the benign neglect side of the equation. They are fallen behind the curve. So this is, and to an extent, for me, Russia is an accelerator of the regime shift.
If the central banks are behind the curve, Pascal, has the curve now completely changed? I mean, they're not going to want to raise rates drastically to curb inflation when we have such high volatility, are they?
I think at the margin they will do less than more. Actually, less than more than feared or expected. But this is not new, actually. They have fallen already behind the curve. To an extent, they are happy to be behind the curve, I would say. It's a bit provocative, but this is what I think, actually, and this is part of this regime shift. And in particular, the ECB will have more difficulty in a stagflationary type of risk framework to do more, or just to do what is expected. So at the end of this process, I think they will be faced with growth slowing back to trend one way or the other, and inflation staying higher, more volatile, more uncertain.
Are we looking, looking, Pascal, at changes in, not just the investment climate, but in the business setup that are irreversible? Are we seeing changes, especially in Europe, that cannot be brought back to normal?
Actually, I think markets have realized that this is not likely to be fixed rapidly. Actually, contrary to the initial reaction. So we are in a time framework that is a lasting one. And arguably things will be reversed at some point. It's a matter of time, but time has a price in the marketplace. Actually, this is one aspect of the thing. On the investment side, actually, what is important in relation to Russia is that there is the realization that cross-country returns are likely to be less correlated. So this provides opportunities for investors as the global the co-movement of global risk is decreasing actually across the globe.
Pascal, thank you very much. Good to speak to you. Thanks for bringing us your thoughts. Pascal Blanquet of Amundi Institute. Coming up on this programme, we will stick with the war in Ukraine. We'll talk to Wolfgang Munchau, Eurointelligence Director. What role will China crucially play in this? This is Bloomberg.
This is Bloomberg Early Edition. You're looking live at the Principal Room. Coming up later today, former U.S. Secretary of Commerce Gary Locke. That's at 12:30 p.m. in New York, 5:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Russian President Vladimir Putin reiterated over the weekend that the war will continue until Ukraine accepts his demands, dimming hopes for a negotiated settlement. Let's get more with Wolfgang Munchau, Eurointelligence Director, who joins me on set here in London. Wolfgang, are you getting a better sense then of where the West and its allies will and won't go in this conflict? We know more about Ukraine asking for the West to police a no-fly zone, but many voices in NATO and beyond saying that that's a step too far.
Yeah, I'm pretty confident to predict that this won't happen. NATO leaders have agreed among each other that a no-fly zone would be construed by Putin as an act of war. And generally, that is a military intervention. What we have seen, the Americans have held talks with Poland. We will see Poland supplying airplanes, warplanes to Ukraine. That's sort of this side of the limit. If it could be construed. Things are shifting all the time, but in general terms, if arms deals and arms supplies is not an act of war, but a no-fly zone is certainly a military act.
Okay, and do we think that President Putin has the same definition of an act of war? Because I keep hearing lots of European voices like to talk about, and I mean European in a very broad sense here, and other Western voices like to talk about being, using tools of financial warfare against Russia. Is there any sense that this is a dangerous game?
It is potentially a danger. We have used unprecedented financial means. The classic financial economic sanction is we stop trading with you. What we have done is unleash the bazooka right from day one, which is the central bank sanctions. This is the big one, stopping Russia accessing their own money in foreign-held central bank accounts. Now, this might become an issue at some point. I think if we stop trading oil, which would be a much more serious issue, that would clearly not be an act of war, because that's a classic sanction one could normally unleash. But Putin might at one point say, I want my money. And if you take my money, I consider that an act of military, actually, of aggression, an act of war.
Well, Wolfgang, you talk about targeting oil, which the U.S. is now in discussions of doing. Is that the last card to play, short of use of force?
No, it's not the last call, but it's one of the last calls. We have oil, we also have gas, and we have coal. Interestingly, they start with oil. The talk is not about gas and coal, the talk is about oil. Oil can be replicated. You can buy oil on the global market. Gas, certainly if you look at it from Germany or from Italy's perspective, gas cannot be easily replicated. So the idea is not to do everything right now, but just refine. Now, oil is big, no question about it. It is the biggest European import of Russian energy sources, but the dependency is greatest with gas. Now, there are all sorts of scenarios that could happen, that we start banning oil and Russia might, in responding, banning gas, that there are, stop exporting gas to us. There are a number of scenarios that could happen that would carry a risk for Russia too.
Okay.
But it's a risky scenario.
Well, talking about scenarios that could happen, what scenarios do you see for de-escalation? What off-ramp does Vladimir Putin have?
That's very, very hard to see. I mean, a no-fly zone would definitely constitute a massive escalation. I don't think that Putin is going to go on an off-ramp. My fear is that he will pursue his campaign in Ukraine for a long time to come with massive damage, and that the chances of a settlement are very, very slim. But the possibilities are there could be disquiet inside his own, inside the Russian military. It is possible that economic sanctions will at one stage start to bite, and that might induce him to compromise. We are not close to that moment yet. We should also not interpret the difficulties Russia had in the first part of the campaign as a sign that Russia is sort of militarily weak and it won't be able to complete the mission. Maybe it may be that is the case, but I would not at this stage want to predict that. They have weapons.
Wolfgang, clearly they have very large and terrifying weapons that they could bring to bear, and we hope that they won't. With all eyes on Russia right now, does this give China a chance to make moves in Taiwan that it otherwise might not?
Yeah, I would not think that China would use this opportunity to shift its, to invade Taiwan because we are distracted right now. I think this is significantly more complicated. But I think what we could see is that China might actually form an alliance with Russia and make it possible for Russia to feather the sanctions impact for Russia. For example,
but why?
Well, China and Russia are also subject to U.S. sanctions. I mean, you think about Huawei's sanction being sanctioned by the Trump administration, and Huawei has, Huawei could help Russia, and these are two countries that are subject to various forms of sanctions from the West. They have an interest in working together. That would be my central scenario. China also has an interest from becoming less dependent on the US dollar. Now, the central bank sanctions that I referred to in the beginning that I think are quite serious and potentially troubling for us actually in the long run, those central bank sanctions could induce Russia and China to develop an alternative payment system, which would then strengthen the role of the renminbi in the long run.
Yeah, a threat perhaps in the longer term in terms of those conversations about the dollar. Wolfgang, thank you very much for your time. Wolfgang Munchau, Eurointelligence Director, with us this Monday to talk about the war in Ukraine and its effects. Coming up in the next hour, Eurasia Group and G0 Media President Ian Bremmer. That's at 6:30 a.m. in New York, 11:30 a.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. Now, inflation, supply chain disruptions, labor shortages, and COVID-19. Despite all of these challenges facing Americans, U.S. business leaders are more upbeat than ever. And it's drastic. It's dramatic. Matt Winkler, Bloomberg editor-in-chief emeritus, wrote a column about it, and he joins us to talk about corporate American optimism. Matt, there were a few points in here that I was just absolutely stunned by. We cover this every day, and I had no idea that out of the 500 S&P benchmark companies, 300 have said they're going to hire more than they ever have before.
Correct. And part of that is a consequence of what we have been able to achieve since 2020, which is the fastest and strongest recovery from a recession in modern times. We've never seen anything like it. For unemployment to drop from 10+% down to 3.8, 3.7, whatever it is, soon to be. And, that makes a difference. The fact that companies, if you look at their businesses, they're booming. And so it's understandable why CEOs would be so optimistic because, and don't forget, low interest rates, we still have them, okay? This is a big part, is that the debt ratios of American companies have never been better. That means they're healthier. And so with all their record borrowing of late, that hasn't made a dent in their bottom line. If anything, their bottom line is more robust than it's ever been. So one final thing, if you think of the Business Roundtable, that's about 200 CEOs. Every year they do these surveys of what they expect in the future, okay? The end of 2021, it was at an all-time high, the survey, 200 CEOs, Business Roundtable.
Well, and you point out in your column as well how we've seen CapEx on the rise. What are we supposed to make, though, of this divergence between the optimism in the C-suite, really healthy companies, and consumer sentiment that's deteriorating?
Well, unfortunately, I have to blame some of us in the Fourth Estate because we've been inflation mongering nonstop. I mean, that's just been our pursuit of the past year. And it's obscured the fact that not only do people have jobs, the personal income, by the way, last year rose at a record amount, something else was going on at the same time. And so this disconnect between consumer sentiment and CEO optimism is like nothing we've seen before. The last time we saw, the gap that exists today was when they were both falling in tandem, around 2011. So this is really unprecedented. Now, the good news is, at some point, people have to feel a little bit better, and you'll see that.
Okay. Matt, this is making us feel better. This is the most uplifting conversation we've certainly had in the past hour, so that's working. Is there a disconnect also, though, between the way CEOs were maybe feeling, if that's the right word, at the end of 2021 and the way that war in Europe might be making them feel now? I mean, any sense that this is going to be something that weighs on their hiring plans and their CapEx plans?
Okay, you could argue last week when we got Target earnings and Kohl's and lots of other people's earnings, which were much better than anticipated. And the war, or the invasion, if you like, had already occurred. And if you recall last week at this time, everybody said it's going to be a disaster, Ukraine is not going to be able to resist, and so forth. And here we are today, like we were last week, and the CEOs knew everything that we know about Ukraine, and they were still saying, we like where we are, we like where our business is, and they're not, out of the picture, so to speak. They're very much looking at everything that we see.
Matt, thank you very much. Thank you for bringing us your story. Matt Winkler, Bloomberg Editor-in-Chief Emeritus, of course, with us with his piece, US business leaders place bets on prosperity. Matt Winkler's piece out this morning on the Bloomberg terminal. European equity markets are moving to the downside. They have paired earlier losses, though, down by 2.5%, though, on the Stoxx 600. The FTSE 100 doing a little better than the others, lifted by some of the energy and basic resource names. Those are the two sectors moving higher today, but we have all other sectors in Europe moving to the downside. Oil prices very much in focus. New York crude, WTI at 122, Brent currently trading at 125. It's been as high as 139 during the Asia session, pulling back from those elevated levels. Gas prices taking out new highs in Europe this morning. More Bloomberg surveillance is ahead. This is Bloomberg.